On December 10th, 2008, a man sat his two sons down in his Manhattan penthouse and told them a truth. Not a small truth. Not a manageable truth. He told them that the business he had built over almost 50 years, the business that had made him a legend on Wall Street, was, in his own words, one big lie. By the next morning, he was in handcuffs. His name was Bernie Madoff, and what he confessed to that night was not just a crime. It was one of the largest frauds in human history. Somewhere between $60 and $65 billion gone. Not lost in a crash. Not wiped out by bad luck. Simply, never real to begin with. But here's what almost nobody knows. The scheme didn't start with greed. It started with something far more relatable. It started with a young man who just wanted to be taken seriously. Picture New York City in 1960. Bernie Madoff is 22 years old. He's not from money. He grew up in Queens, the son of a plumber turned stockbroker whose own business had failed under a cloud of regulatory trouble. Bernie starts his own firm with $5,000 he saved from summer jobs, lifeguarding at Long Island beaches and installing sprinkler systems. $5,000. That's it. That's the seed of what would eventually be called history's biggest financial crime. And for a long time, it wasn't a crime at all. It was a genuine success story. Madoff was smart. He was early. He helped pioneer electronic trading at a time when most of Wall Street still ran on paper tickets and shouting men in color jackets. He eventually became chairman of NASDAQ, the same stock exchange that would later list Apple and Microsoft. Think about that. The man who would go on to run the largest Ponzi scheme in history once helped build the very infrastructure of modern American investing. So how does someone go from building trust to destroying it on a scale nobody had ever seen? That's the real story. And it's stranger than most people realize. Madoff ran two businesses under one roof. One was completely legitimate, a market-making firm that executed real trades and made real money. The other, his investment advisory arm, was where the lie lived. And the lie was almost embarrassingly simple. When you gave Madoff money to invest, he didn't invest it. He just kept it. Then, when other clients wanted their money back, he paid them using cash from newer investors. No stocks were bought. No real returns were earned. It was a circle spinning faster and faster, and it only worked as long as more money kept coming and then going out. This is called a Ponzi scheme, named after Charles Ponzi, a con man from the 1920s who ran a similar trick with postal reply coupons. But Madoff's version wasn't crude. It was elegant. It was patient. And that patience is exactly what made it so dangerous. Imagine being one of his investors. You don't see wild, suspicious gains. You see steady, almost boring returns, something like 10 to 12% a year, year after year, even when the rest of the market is falling apart. No panique. No red flags. Just quiet, reliable growth. That consistency was the whole trick. Real markets are messy. They go up, they crash, they recover. Madoff's numbers never did that. They were too smooth. Too perfect. And for 2 decades, almost nobody stopped to ask why. Here's the emotional core of this story, the part that gets lost in the headlines about billions of dollars. This wasn't just Wall Street tycoons getting fooled. Madoff's client list included Florida retirees who had handed him their entire life savings, trusting him the way you'd trust a family doctor. It included Hollywood names like Steven Spielberg and actor Kevin Bacon. It included Hall of Fame pitcher Sandy Koufax. It included hundreds of charitable foundations, groups that existed to help sick children, fund scholarships, feed the hungry. Several of those foundations were wiped out completely and had to shut their doors forever. That's the part that should make your stomach turn. This wasn't a victimless numbers game. It was trust weaponized. And here's the twist that almost nobody talks about. Madoff wasn't hiding in the shadows. He was one of the most respected men in finance. People didn't just invest with him. They begged to invest with him. Getting into his fund became a status symbol at country clubs and charity galas across the country. If Bernie Madoff would take your money, you had made it. That exclusivity, that feeling of being led into an inner circle, is one of the oldest psychological levers in the world. Humans don't just want good returns. We want to belong. We want proof that we're smart enough, connected enough, trusted enough to be chosen. Madoff understood that better than almost anyone in financial history, and he used it like a weapon. So why did it take so long to catch him? This is where the story gets genuinely infuriating. A financial analyst named Harry Markopolos looked at Madoff's returns back in the late 1990s and immediately knew something was wrong. The math simply didn't add up. He calculated that Madoff's strategy, as described, was mathematically almost impossible to sustain. He brought his concerns to the Securities and Exchange Commission, the government agency responsible for catching exactly this kind of fraud, not once, but multiple times over nearly a decade. And every single time, regulators investigated superficially and walked away, convinced there was nothing to see. We'll come back to why that matters. But hold on to that feeling of disbelief for a moment, because it's about to get worse. For almost 20 years, the machine kept spinning. New money came in. Old investors got paid. The lie held together because trust is remarkably durable, right up until the moment it isn't. And in 2008, the moment came. The global financial crisis hit, and suddenly, all across the world, investors panicked. They needed cash. They started pulling money out of everything, including their accounts with Madoff. Normally, that wouldn't be a problem for a legitimate fund. But Madoff wasn't holding real investments he could sell. He was holding a shrinking pile of cash that had to cover a growing wave of withdrawal requests. Investigators later found that in the final days, clients were asking for around $7 billion that simply did not exist. The circle had finally run out of momentum. Picture Madoff in that final week, watching numbers that had worked for 2 decades finally refuse to balance. There was no more math trick left to pull. No new pool of investors big enough to cover the hole. Fast forward to that night in his penthouse, confessing to his own sons that everything they thought they knew about their father's life work was fabricated. Imagine being one of those sons, learning that the man who raised you had been lying not just to strangers, but to you for your entire life. The fallout was brutal, and it didn't stop with Bernie. His sons reported him to authorities themselves. One of them, Mark, would take his own life exactly 2 years later on the anniversary of his father's arrest. His other son, Andrew, would die of cancer a few years after that. His brother Peter, who worked alongside him for decades, was later sentenced to 10 years in prison for his role in the scheme. A family that once represented the American dream of building something from nothing had been shattered by that same something turning out to be nothing at all. Madoff himself pleaded guilty in March of 2009 to 11 felony counts, including securities fraud, money laundering, and perjury. The judge sentenced him to 150 years in prison, the maximum allowed by law, calling his crimes extraordinarily evil. Madoff would spend the rest of his life behind bars, eventually dying in a federal prison medical facility in April of 2021 at the age of 82. So what do we actually learn from all of this, beyond just being angry at one man? Here's the financial lesson, and it's one worth sitting with. Madoff's entire scheme depended on one psychological trick: returns that were consistent instead of realistic. Real investing involves risk. It involves years that are great and years that are painful. When something promises smooth, guaranteed, unshakable growth no matter what the market is doing, that isn't safety. That's often a warning sign. Loss aversion, our deep human fear of losing money, makes steady returns feel comforting. But markets aren't steady. They were never designed to be. Anyone offering you certainty in an uncertain system is either lying to you or lying to themselves. There's a second lesson here too, and it's about identity and belonging. Madoff's victims weren't foolish people. Many were sophisticated, successful, careful with their money in every other area of life. What got them wasn't stupidity. It was the powerful, very human pull of exclusivity, the sense that being chosen by someone trusted and respected meant they didn't need to ask hard questions. That instinct exists in all of us. It's worth remembering the next time something, or someone, feels too respected to question. And this story isn't just history. The same psychological blueprint shows up constantly today. In crypto schemes promising guaranteed daily returns, in investment clubs that only let in the right people, in influencers who flash results without ever showing the risk behind them. The names change. The technology changes. The trick stays exactly the same. If this story made you rethink how you judge trust, whether in money or anywhere else in life, that's worth sitting with for a second, and it's worth telling someone else who needs to hear it too. In the end, Bernie Madoff didn't destroy people's finances with some brilliant, complicated scheme. He destroyed them with something much older and much simpler. The human need to believe that someone, somewhere, has figured out a way to make the uncertain feel certain. And if this story teaches us anything, it's that the moment something feels too safe to question, that's exactly the moment we need to start asking harder questions. So if you don't want to miss the next story that changes how you see money, make sure you're subscribed, because the truth is always stranger and more useful than the version we're sold.